Well, it's my privilege to welcome everybody to this workplace savings function. I'm not sure where to look at. I can look at the screen, I can look at the camera, and I can look out here. So I look at all three places at once. It's very enlightening. But isn't it great to finally have a chance to get together? Because that's something this year we haven't been able to do much of at all. We've had conferences canned and many events sort of canned during the year. So it's just great to get together at this time of the year to talk about next year and forget about this year. I want to thank, first of all, Dentons and Chapman Tripp for hosting us today. Thank you very much. That's appreciated. The format today is I'm very shortly going to hand over to Gavin, who's going to lead off talking about his statistical analysis of our industry. Then Mike is going to give us a legislative and policy update, and then Tim is going to finish off by his views or observations of the last 12 months, and Kat's going to give the farewells at the end. Before passing over to Gavin, I just wanted to sort of briefly reflect on the last 12 months, and I think that really it's only 12 months ago the committee was formed. And looking back, I think Paul and I are pretty happy with how things are developed and what the last 12 months has brought to us. We're very fortunate to have a committee that's very passionate and very committed to helping the industry and engaged on the betterment of the industry. And I think I want to thank all the committee for their contribution. But it's not a closed committee. The door's always open, so if anyone that wants to join, then they're more than free to do so. The sort of things that we've been doing, I'm going to kick off by the last thing, which I'm quite excited about, and that's the trustee training program. We set out to do this, and I'm very pleased, as at yesterday, the last of the three initial podcasts. It's in the can, isn't it, Tim? Tim and Brian yesterday. It's been recorded. So we now have three on governance and investment and an introduction. They've all been done. And the first one I know on introduction has been edited, and that was Philippa and David did that. That's fantastic. And the investment one has been done, and now Brian and Tim. So that's exciting. That'll be out before Christmas, and there'll be more about that over the next 2 weeks. But we've been pretty active on engaging with regulators, and Gavin, thank you again on behalf of the industry for your open door and your wise words, wisdom, and support. You've been formidable as you always, so thank you very much for that.
Yeah.
We made submissions on a number of, submission on a number of new regulations, new legislation, and guidance notes. And so we, on behalf of the industry, have submitted into that process, but that's been quite busy. Also, the conference, we're very keen this year to have a strong workplace savings stream at the conference, and I think we were delivering that, and we'll continue to work on that. But also, I think FSC, the umbrella of FSC, their support for us has been tremendous. Hayley has those minutes out before you get back to your office, and she's chasing up your actions, the support, and also for this function. As Richard said yesterday, this is the first time FSC have held a function like this with Auckland and Wellington different hosts, but it's also Zoomed, and touch wood, it'll work well. The right sizing, the regulatory regime has also been a big part of our focus too. That was started, David, with you under the old workplace savings. That's continued, just trying to get those compliance costs down. We work at that. We continue to work at that. But the most pleasing thing, I think, has been our increased membership. We put a big effort into trying to increase the membership of the workplace savings schemes, and we've achieved that. And so I think all those new schemes that have come on board, and we hope that we can deliver on and what you have joined for. So thank you for the support. Now, with all that, I thanked everybody. I want to thank the committee. I think I've done that too. So Gavin, without that further ado, over to you.
Thanks, Alistair. And thanks to FSC for organising and putting this event on. if I start with the statistics on which I've previously provided at FSC conferences, and I'd done the work on it in anticipation of having a fireside chat with Mike. That didn't eventuate, but the work is still useful. So in terms of the statistics, I've just looked at only the restricted schemes for this particular slide, and at the bottom in red are the numbers that were effective at 2017, which is really when the regime switched into FMCA from the old Super Schemes Act. So sort of that's my baseline that I continue to look at, and as you can see, there really hasn't been that much change in terms of membership and assets under management, and that's assets under management in relation to 31 March 2020 for the majority of schemes. So that also takes into account the volatility that occurred at that time of the year. I've sort of sliced it slightly more refined in terms of workplace savings schemes themselves, excluding NPF and excluding the 3 restricted employer-based master trusts. That leaves us with 79 standalone workplace savings schemes, and for you guys, 621 million of contributions flowed into those restricted schemes, and you paid out in benefits, including pensions, 728 million. So it just sort of is just an added little statistic which just shows the level of enthusiasm, I suppose, in relation to many trustee groups that they still look to keep their schemes open, and in relation to even closed schemes, that the contribution levels are still significant. In terms of the pensioners, if I exclude the NPF pensioners, that number drops to 5,160 odd pensioners. So certainly in the defined benefit space, that's now a very small cohort. And in recent discussions with people, I think sort of in terms of employers looking at their costs in the current environment, post-COVID, I think we could see some pensioner offers for commutation and some further rationalisation in that space. Anybody got any questions or observations on the stats?
Kevin, what sort of traffic did you have over the course of, let's just say, the last 12 months in terms of, scheme restructurings, transfers into master trusts, the sorts of things where you have a consenting role, and how much sort of money and what sort of members were involved?
Off the top of my head, I'm not sure about the numbers, but certainly I suppose during COVID it got a little bit quiet when everybody was working from home, but in the 12 months to 30 June, we did 3 compulsory transfers. They were I think in all cases, master trust to master trust, or legacy retail going into another retail superannuation scheme. So that hasn't been that active, and I suppose that's also highlighted by the small reduction in the number of schemes since 2017. At the moment, I've just approved a master trust to master trust transfer I know that there's one that is a standalone scheme into Master Trust, which is imminent, and one other Master Trust to Master Trust employers transfer that's in the process, but we haven't yet seen final documentation for that. And it may be that people are now saying thinking that it's getting too close to Christmas and we should wait until the new year so that members can, in fact, have the time to review the packs. So, yep, certainly there's interest out there and a little bit happening. In the deed amendment space for the year to 30 June, I'd consented to 20 deed amendments. Since 1 July, I've dealt with a further 16, and they just seem to be pouring in the door on a daily basis at the moment. Many of them are starting, the ones that most recently received are starting just to tweak their deeds in relation to the Trust Act 2019 requirements, if it's necessary within the deed. In terms of its structure, a few benefit design tweaks. Some trustees are looking or have looked and changed the nominated beneficiary aspect to more match mainstream KiwiSaver schemes, and that's always open to have a discussion with advisors or trustees about that process.
So the question on that, if your trustee changes for the Trust Act are relatively minor in the scheme of things and it's covered by the legislation anyway, is it something, what's your attitude to sort of saving it up till the next time you do something big, as distinct from tidying it up now, and not bother you with it?
I'd have to defer that question to the legal fraternity. I suppose it comes down to whether or not I think the deed has got hard-coded obligations. But yeah, certainly I think there might be differing views out there in relation to whether or not it's something that must be done by end of Jan 2021, or whether it's something which could be left and saved up, as you say, Tim.
But you don't have a particular view.
I don't have a particular view, no.
Cool.
An interesting little twist that's come up 3 or 4 times over the last little while is the Human Rights Act. And people doing deed amendments in relation to schemes where, and forgive me for having been around for so long, I might think that the Human Rights Act might have an implication, even though it's really got nothing to do with any part of my consent process, but I do take the opportunity to flag to people that have you thought about the Human Rights Act in relation to this aspect of your proposed deed amendment. And some of those, on reflection, the amendments have been changed, or if it's a transfer, on advice, the transfer pack has been amended accordingly, and on the odd one, people have thought that it's all okay, so that's fine by them. They can discuss it with the Human Rights Commission if they ever need to. From a member complaint perspective. But yeah, it's interesting that I think that piece of legislation might have sort of fallen off the radar for some people when they're looking at doing amendments which might have implications for different categories of member, or whether it's something that's service-based versus membership-based, where the Human Rights Act and the original guidance issued for superannuation made distinctions and sort of tried to clarify what their expectations were. So yeah, it was sort of interesting aside. I'd take the opportunity as well to thank and congratulate the Workplace Savings Committee on getting the trust training up and going. It's been something I've banged on about ever since it sort of stopped. But I know that various law firms have filled the gap in between, and hopefully what you've produced will be a great asset to new trustees that join trustee boards, and also just as potentially refreshers for licensed independent trustees or new licensed independent trustees that we issue a license to, of which there's been a couple in recent times. In terms of the right-sizing the legislation update, yes, it went very quiet. We sort of, the resources within the FMA and the policy team that have been working on that off and on got diverted to deal with COVID issues. Some of those COVID issues, of course, benefited restricted schemes. So I'm sort of now at a point where that's being picked up again, and we hope to come out with a targeted consultation paper in the first quarter of 2021 for the industry to look at what we see as the solutions. And those are solutions in relation to the quarterly fund updates for DB schemes, for those schemes which have interest on withdrawal benefits or voluntary contributions. The residual fund update for after the last member's left but before the next balance date. Quarterly reporting of our dearly beloved limit breaks and related party transactions, and the annual confirmations for DB schemes, which aren't even sort of contemplated in the current regulations. So I suppose those are what are at this point in time identified.
Any questions?
Can I just make some clarity there? Gavin, can you hear me right?
Yes.
Yeah, so just in terms of the member certificates which are required to be provided within 3 months of balance date, and there was suggestion that they push that out to 4 months and line up with the annual financial statements. Is that still on the cards? Is that what you're referring to?
That particular one, Brian, is one which needs a legislative fix, and it has been passed to MB, and it is on MB's work list.
Okay, thank you.
Don't hold your breath. Sorry.
Thank you, Tim.
Just putting words in your mouth, sorry.
In terms of the last slide, which Mike kindly dropped into the pack in relation to the Good Conduct Guide, I might cover it now rather than wait for the very end. And I suppose, I had the pleasure of attending a full trustee meeting at the invite of the chair, which was a very interesting day. I thoroughly enjoyed it. It was very interesting to see the way in which the trustee board functioned, how the licensed independent trustee performed, and
Wasn't me.
No, it wasn't. And yeah, just how, for me, how much in fact the trustees in many instances relied very heavily on both the chair and the licensed independent trustee. And I suppose in that vein, from a good conduct perspective, I think our expectations are that LITs will be ensuring that fellow directors and trustees leave their employer head outside the door when they step inside. By the way, that didn't occur in the particular trustee meeting that I attended. It wasn't an issue. That everybody is acting in the best interest of members. Outsourced providers are held to account, and that the trustee board, reviews the fees from a value for money to members' perspective from time to time, and the standard stuff, which I don't probably need to tell you, of acting fairly, not misleading, ensuring the trust deed and the legislation are complied with, and that compliance registers are well maintained. There's a robust member complaints process in place, which members are able to access easily and are made aware on a regular basis that it exists. Would be just some off-the-cuff thoughts and observations in that space. I'm happy to hand over to Mike.
Well, thanks very much, Gavin. I know I'll be very brief because I know people have come principally to listen to your and Tim's insights, but I've been asked just to take people through necessarily fairly selective update on legislation and policy. General themes, I guess, heading into 2021. There is no question that financial services regulation is becoming gradually more rather than less complex, and the delivery of new regulations continuing apace. A little bit of consultation fatigue setting in from parts of the sector, and certainly maybe at retail anyway, some implementation fatigue. And all this is happening at a time, as we know, of emerging or increasing risks to financial services providers arising from other developments like ESG, climate change and sustainability issues, which of course translate into economic risk and investment risk for you guys as managerial trustees. But 2020 was relatively steady as she goes, I think, from a restricted schemes perspective, whilst also offering a number of highlights. So I thought I'd just batch them into sort of themes and step people through them. We'll welcome any comments or queries or colour commentary from Gavin or Tim. COVID-19 and other exemption relief initiatives and developments. Look, we're all familiar now with the Financial Markets Conduct Custodian Assurance Engagement exemption, which was issued in March and took effect on 31 March. And I guess we're now nearing the point, guys, where it's being invoked for the first time, or we're there already. We all know what the basic threshold qualifying criteria are for this invaluable exemption, but I guess just a heads up to scheme trustees and admin managers to be really carefully mindful of the prescribed process requirements. And those include the admin manager, as well as, of course, obtaining its own FMCA compliant custodial assurance audit, certifying a number of things. Firstly, that all scheme property admin was outsourced to it during the relevant year, that all the contributions were paid to and all the benefits were paid from a scheme bank account which only the admin manager, Steve Grant or Philippa or their equivalent, was authorised to operate, that the scheme property met the standard assets condition all year round, and that during the relevant period the admin manager gave the trustee board quarterly or more frequent reports on contributions, withdrawals and other transactions. So we've got to make sure that we get those dead right, and be good to hear from Gavin if there's any emerging conniptions there in terms of what those look like. The admin manager's also got to copy the auditor's report and its certificate to the trustee and FMA, and the trustee for its part needs to advise FMA that it's relying on the admin manager's report and certificate. And what we've all got to remember, because of course this has been a pretty challenging year and issues were encountered, is that if the report is qualified, the exemption notice can of course still be invoked and relied upon next year, as long as in the interim FMA was notified of the reasons for any qualification and the steps taken by the admin manager to resolve them and the auditor confirms for its part that those were satisfactory. So I suppose as a committee we're really keen to hear if there are any issues emerging at the execution phase of just invoking that valuable exemption, but as we step into it, let's just be mindful of those process requirements. During the year, we also got a really welcome, yeah, Gavin, you go.
Just in respect of the application of it, I've had discussions with both Mercer and also with MJW in relation to our expectations. Basically, we look to get one copy of the actual auditor's assurance report. Don't need to cut down to any other trees, and one copy is sufficient. And each trustee board needs to supply us with their letter confirming that they are relying on it, and that and supplying us with a copy of the personalised certificate from the admin manager.
Yeah, good stuff.
Mike, just to clarify, we're talking about trustee boards, but we're really talking about custodians. So those.
Yes, trustee boards in their custodial capacity. Yeah, that's right. Yeah. Well, during the year, we also got a range of very welcome 2-month timing extensions for compliance with reporting and audit obligations during the COVID-19 lockdown period. A quick look, I guess Steve and Philippa in particular, at the disclosed schemes register shows it was reasonably widely invoked, which is gratifying. And Gavin, I guess, although that's effectively now run its course, one hopes that it's set an excellent precedent and we can bust out something similar again if we, God forbid, we need to. Another piece of relief was the Oaths and Declarations Modification Order. This was the temporary law change. Again, it's now run its course. It was revoked effective 24 September, but it modified the requirements for signing and witnessing oaths, affirmations and declarations under the Oaths and Declarations Act. And it had particular relevance to KiwiSaver schemes, including restricted schemes and complying funds, which require stat decs, of course, to allow various withdrawals. It allowed a declaration to be taken using an audio-visual or audio link so long as certain conditions were met. It also enabled a declaration to be taken by a duly authorised officer or employee of the manager, which in this context means the trust board. We think it was an improvement. As a firm, we think that was an improvement that really the regulators should look at keeping. And we've requested as a firm that the government consider extending the relief provided by that order more permanently. It really helped the vulnerable, and technology's come a long way since the Electronic Transactions Act was enacted nearly 20 years ago already, with applications like Zoom and Skype, and of course look at us all now, able to provide the functional equivalent of physical attendance, and are now routinely used by Kiwis for their daily interactions. So we've made that submission, and to the extent that there are concerns that the use of audio-visual links could compromise evidentiary and record-keeping objectives around affidavits and stat decs, we think those can be adequately addressed by looking at the type of conditionality that was in that modification order. And better still, we've commended amending the law to require only certification of the relevant information and not a stat dec. That's almost equivalent solemnity, but fewer potential process and timing impediments. And in practical terms, the consequences of making a false declaration or making a false certification are substantially the same. Another initiative we took during the year was mid-year FMA sought submissions on the review of a range of expiring class exemption notices, and one of them on which we gave feedback was the Licensed Independent Trustees Exemption Notice in place since 2016, which expires next September. And as we all know, in a nutshell, this of course means that a licensed independent trustee who is in substance independent isn't treated as failing the independence test simply due to being a director of a sole corporate trustee that's related to the sponsoring employer or an admin or investment manager. Because loss of this exemption would render the governance of most schemes non-compliant, naturally we submitted that it should be rolled over in its current form. I had a wee look at the register, and north of 40 schemes are relying on the exemption, whereby a LIT's independence isn't compromised just by reason of their status as a director that's employer sponsor owned. And there's also several restricted legacy super schemes invoking other elements of that exemption. So we'll keep an eye on that and make sure that's rolled over. Just got to scroll down here, forgive me. So the next thing was other legislative developments. And Gavin, you mentioned the Trusts Act 2019. I guess we're in the camp of thinking that, that's of relatively minimal significance for workplace savings schemes that are registered under the FMCA. In and of itself, it largely updates or restates law that exists already, either in statute or in case law. It comes into force on 30 January 2021, but it's not like the FMCA. It's not as if your trust deed isn't entirely consistent with the Trusts Act 2019 on 31 January 2021 that you'll be non-compliant with the Trusts Act. It's not analogous in that sense. Though there are a number of new changes, many of them won't apply to schemes registered under the FMCA, as I mentioned, and a good many others can be modified or disapplied by the trustee. It adds a new section to the FMCA under which over 80 sections of that statute are expressly disapplied in relation to an FMCA registered scheme. And the purpose of doing that is to avoid, of course, duplication or inconsistency as between the FMCA and the Trust Act provisions. Nevertheless, the Act isn't irrelevant. Our house view, though, is that we should prescribe amendments to recognise it as the occasion arises. In other words, when you otherwise have occasion for amending a deed. And at a minimum, we consider it sensible to have a provision which just clarifies that if there are any specific provisions in a deed which are inconsistent with some of those default duties that apply unless they're modified or excluded by the deed, we just make very clear by amendment that the deed prevails over the Trusts Act. We're also getting a new Privacy Act in about 10 days' time, replacing the Privacy Act 1993 on 1 December. From a restricted scheme perspective, probably the key change is there is mandatory privacy breach reporting regime that now takes effect. So privacy breaches causing or likely to cause serious harm will now need to be reported to both the Office of the Privacy Commissioner and to the affected individuals, unless an exception applies. So really what that means at this juncture is just that schemes should be updating their policies just to build in a reporting requirement into data breach processes. A number of schemes represented here today will be PIEs. Of course, on 1 April 2020, and we all did cartwheels, there were significant changes made to the PI tax laws that allowed a year-end square-up, whereby, importantly, overpaid PI tax can now be repaid, and underpaid PI tax is just payable as part of the income tax year-end process. That meant updates to offer documents, the PDS in particular. We have protection from non-compliance risk through until 31 January 2021. We're still awaiting and we're pushing for the new wording on PI tax for inclusion in a scheme's PDS. The regulatory wording is still pending, but FMA sent, and you should all have seen some draft wording in early September, and they encouraged its use. And FMCR allows schemes to amend PDSs ahead of that formal regulatory change to render them correctly descriptive of the amended PI tax provisions. So encourage you to do that in good time. During the year, we also added to the KiwiSaver Ledger, by extension, compliant fund rules, this new, reasonably exceptional, but nonetheless important, early withdrawal facility being withdrawal for a life-shortening congenital condition. whereby a member can withdraw an amount up to the full value of their locked-in or KiwiSaver balance at any time before age 65 if they suffer from a condition which is congenital, which means, of course, one they were born with, and is either one for which they have medical evidence to demonstrate that they or the typical sufferer won't reach age 65, or it's a listed condition, one identified by regulation as life-shortening. And just letting you know that, again, whilst we're keeping a weather eye on it, this list of automatically qualifying conditions is yet to emerge. Last we heard, and it's a bit of a running theme, I guess, here, is it's likely early 2021 due to subject to Cabinet priorities. There's a few other technical points with which ourselves and Dentons have exchanged on which we've exchanged one or two emails, but I suppose one thing to bear in mind here, and particularly when you have occasion as a complying fund to next amend your trust deed, annoyingly the new facility isn't implied into a complying fund trust deed. The new ledge effectively requires its addition by amendment, but that's a straightforward tweak. During the year, just putting the balloon up in case people hadn't read about it, the draft amendments to the tax statute finally have yielded to our entreaties whereby New Zealanders, which are estimated to have some $6 billion or so sitting in lost accounts with the Australian Tax Office in Australia, will now be permitted in due course when that ledge takes effect by exchange of legislative affirmation to transfer the money straight from the ATO into their chosen KiwiSaver scheme. We're yet to win the argument that complying funds can participate, and likely we won't, but that's something noteworthy. I was asked to talk briefly, next slide, just on developments around good conduct compliance. As most of you will know, the bill that we're all calling the coffee bill, the Conduct of Financial Institutions Amendment Bill, which amends the FMCA, emerged in August from its select committee process. It's got cross-party support, so it's a done deal, and it'll require financial institutions to be licensed by the FMA. It'll also require them to have a fair conduct program and take all reasonable steps to conform to a fair conduct principle, clarified through a range of factors. It'll come into force 3 years post-enactment, so it's a wee way away. More significantly at this stage, though, financial institutions for coffee purposes does not include restricted schemes or restricted scheme trustees in that capacity. At the moment, it just means registered banks, licensed insurers, and licensed non-bank deposit takers. But for the purposes of our discussion here today, its principles do have some relevance. The fair conduct principle, which Gavin talked to earlier, is really pretty intuitive. It's that a financial institution must treat consumers, which in this context means members, fairly, including by paying due regard to their interests. And fairly is intended to be a deliberately broad concept, capturing a number of different principles and aspects of how we all ought to behave: being open, being honest, not being misleading, not taking unfair advantage, no undue pressure, acting professionally, and so on. More particularly, the FMA, as Gavin said, forget about the coffee bill, does now expect all financial services providers, and that includes restricted scheme trustees, to undertake and document an assessment of their business against the principles of that 2017 FMA conduct guide and the other good conduct guidance which FMA has continued issuing. Most of you will be familiar with the FMA's good conduct wagon wheel, which I've put up on the slide there, but the FMA's 2019 annual report, which is still the latest as of yesterday, Gavin, also articulated with some more colour FMA's views on what delivering good customer outcomes means. And of course, I've substituted members in place of customers and done some other paraphrasing. Treat your members fairly in all interactions. Recognise and prioritise the interests of your members and effectively manage conflicts of interest as they arise. Give your members clear, concise and effective information, and ensure adequate complaints and claims handling. Lastly, we need to effectively monitor our own conduct and, where relevant, the conduct of service providers to ensure that we can identify, rectify and learn from mistakes. So that's all good motherhood stuff, but nonetheless really important, and it belongs not just in the bottom drawer, but in policies that are lived and breathed by trustee boards. Just a couple of quick heads up, just finally I'll hand over to Tim. Other relevant guidance during the year that you should all be aware of: FSC first home withdrawals guidance, non-binding of course, but incredibly well written, designed to help bring industry consistency and drive better member outcomes. A lot of our schemes build in first home withdrawal facilities, and they're structured using a Q&A format, and they're a very useful resource for scheme admin managers and trustees. And there are significant financial hardship guidelines which are undergoing a corresponding review at the moment, and when reissued, they'll follow a similar format. So commend those to you as FSC members. And in May 2020, in case anyone missed it, FMA issued some really useful guidance on SIPO limit break reporting, again in Q&A format, which remains pertinent given the ongoing risk of market volatility. Lastly, in this space, the one thing we're keeping an eye on is FMA funding and levy requirements for restricted schemes. We all know the outcomes. We submitted long and hard that even as matters stood pre the increases that were announced in May of this year, levies imposed on restricted schemes collectively outstripped actual FMA policing costs, so to speak, and the resulting cross-subsidy, particularly when you look at a per capita impact and the low risk ascribed to this sector, justifies a differential fee structure. It appears we got a few runs on the board. At one stage they were mooting for a scheme worth between 100 and 500 million, an increase to as much as $40,000 in that annual levy. It was confirmed at an increase of, it's gone from 25 to just 26.5. So we're going to keep an eye on that because the levies are increasing in instalments, and we'll be fighting hard for applied common sense, which is that we're probably at that level even more meaningfully cross-subsidising other market participants. So that's me. Sorry to talk like a race commentator. I hope that was helpful.
Thanks, Mike. I guess it moves on to me, does it?
Yep.
Well, just to start, Alistair and I think Gavin talked about the trustee training, and I must admit, having with Brian, I think he's in Auckland, had that experience yesterday to do module 1 on good governance. It's probably a regret that it's not a standard lit competency that you have to have had media training, because I looked at and go, self-criticism is very easy when you're looking at yourself on the screen. But anyway, we'll see how it comes out in the fullness of time. It's good experience, and I think they'll be a great resource. And the whole idea, they start the introduction, and we can follow up with specific topics that are going to be of interest at stage 2. So, and it's a topic really, this whole use of technology and Zoom and all that stuff and webinars. It was one of the lessons I've had this year with the schemes, really. And I like everybody else that was talking, I was going to start, well, it's just business as usual, really. In many respects, it has. You know, financial year end went okay, and we went through the audits all right, and we've been doing all that stuff. No great dramas and all that stuff. It's been very unusual in the world, and markets been all over the place, but there have been some changes, and one of the most notable really is actually the flexibility that the technology has given my trustee directors. Really, we're no longer bound by the quarterly cycle, really, is what I found. It's great to get together, and it's really important you get together as a board, but you no longer have to be captured by a quarterly cycle where you have to do stuff. You know, getting people together for an hour by Zoom is no big deal. And if you want to get on and do it, get on and do it. So that's been one of the real lessons that I've taken on, and one of the benefits of just grappling and getting people to start using this technology and starting using this mechanism of getting and talking together. You know, if you make a decision about something and you want to progress it, well, there's no reason why you can't just get on and progress it. And that's been a real plus. using Zoom for a big meeting is horrible, but it's a plus for smaller stuff, you know, and increasing their flexibility, responsiveness, timeliness is all really good. So from that point of view, it was good. You know, we're all moving on in terms of just dealing with the legislative changes, which again is just business as usual. These things just continue to come. Privacy, that's just stuff they keep on dealing with. And sure, I'm sure many schemes some schemes have had specific issues, whether it be your defined benefit and depending on your valuation date of March versus June and all sorts of things, you might have had issues. You know, some of the sponsors might have had issues about membership, continuation, all sorts of things, but they are very scheme specific. Market volatility, it's been here before, and for me, it's almost been a repeat act, part of it, of the GFC. The volatility seen in March, April, May, sort of my scheme saw switching again at levels I hadn't seen since the early days of the GFC. What is unusual this time is the pace of recovery, I guess, and for me, we are going to have to deal with or think about the consequences of people having switched, the opportunity gone, and how quickly do they make a decision to what happens now. For my other schemes, some of my schemes in particular, some members took a very long time to readjust or rethink and struggled with that. And so communication going forward without giving advice is critical in that framework. The other things that are brought back to mind in our environment for a lot of schemes with set interest rates, which are naturally have time constraints or time limitations and approximations. You're just going to continue to review whether they are fit for purpose and working in an environment where things are moving around a lot, and if they happen to coincide with large switching requests or large withdrawal requests. How does that work in practice? It's important in this framework to have reviewed your policies if you had any doubts about that. From experience that I've found for my schemes, which say, for example, switch monthly at the end of a month, members didn't really understand it very well. No matter how much you've told them how it works and so forth. The proof of the pudding is when they actually come to switch and they give a request, and like, oh, why does it take a month? You know. So again, it came back to just reinforcing the need to keep good communications up, explain how things work and why things work. If you're unit pricing daily, it's quite different from if you're setting unit interest rates monthly. These are not new things; they're just reinforced aspects that pop up every so often. That we've had to come across. So for me, the main issues I'm dealing with at the moment are trying to make sure our communications are good, working through these now. We've been through them, we've had a lot of people switch, we've had them sitting in these funds, which now aren't earning anything. I've had, you know, one of my funds I had over 10% of members switch in over that period into cash or conservative, and they're largely still all there. So it's about shaping expectations about, that's fine from a risk point of view, but it is, you've got to be conscious of what the return expectation should be. So it's shaping expectations of returns going forward, as well as trying to encourage members to keep on reviewing and thinking about their circumstances and what they're doing. So it's a constant program. We've all been trying to do it for years to get member investment choice better understood. This last 10 months, 7 months, brings that back to the fore even more so. The impression I have is that scheme governance as a whole is tracking pretty well, as evidenced by Gavin not having a lot of complaint to direct back at us. And we all continue to improve where we can, and the comments by both the gentleman before me about conduct and cultures is sort of a good example of that. A lot of schemes have frameworks in place where you review your framework and your governance and your board performance periodically, 1 year, 2 years. Might do a questionnaire about board performance, that sort of stuff. The conduct and culture FMA framework now, it gives you a really good framework to shape that well. The 5 C's of capability, conflict, control, culture, communication give you some really good headings to to work a governance review and say, okay, how are we doing at the aspects of third-party management, of the effectiveness of our policies in respect of conflicts of interest, whatever they may be. So they all have, there's a good series of questions you can build up under each of those headings, and if you go through a set of governance, you will be able to demonstrate to anybody who looks, including the FMA if they came looking, that you are really focusing on what you're doing for members is appropriate, you're identifying that you are offering value, and your processes and support infrastructure means you have the capability to keep on doing this well. And that's all in the interest of members. It's helped by the fact that we're all not-for-profit, so we don't have to worry about shareholders and all that stuff, but we've still got to go through that process. So I'd encourage you all to take that framework of the 5 Cs, and it's very similar to the Set of Directors 4 pillars, similar concepts to build around. And we'll talk about this in presumably, or maybe in one of the webinars that FSC does in the fullness of time, because it's a natural, how does governors look at periodically at what they do, and what are the good questions to ask yourselves. So we'll look at that, and I'm sure that will come down the track. But Brian and I have to get through part B of our Governance 101 first before we think about that. But it will be touched on during that, because we will use those 5 Cs to frame that introductory conversation. So hopefully that works out well. So for me, there are a lot of aspects of this year that look like the GFC start. That we just had to refresh ourselves about what do we have to look at then, what issue do we need to look at for the scheme, particularly mistiming of interest rates and payments to members, so you can best coordinate and align assumptions and timings as best you can, and how do you communicate well to members to get their expectations going forward so they can think about the decisions they've already taken and keep that in context. So that's me. I'm hoping next year will be nice and easier and still business as usual. We will see. This year was different in many respects, in a wider sense, but for our business, our schemes really trucked on, still delivering what members are looking for, and that's good. So I'm done, unless there's any questions on that.
Another slide somewhere.
Sorry?
When's the world premiere of your webinar? When can we access it?
I'll have to ask the chair here about the expectation.
Before Christmas? Before Christmas, I think there's a meeting, I think the week after next, to finalise the marketing and comms and accessibility.
The whole idea of those is, I think as everyone's made clear, is that it's a resource. If you have a new trustee, particularly in-house, non-expert, just wants to get a feel for some of the key issues, then they're easily available as a starting point to get them thinking about what's important. The stage 2 is really the next stage, which is really important then about, okay, what's the next level of detail that you want to get? What are the particular topics that add most value to spend some time on? And that's where any feedback, I think, to the committee on what that might look like will be valuable, because it's what's of use, what topics are most of use for trustee groups to be able to access and hear views on.
And the first one is the introductory one, because that's been through the editing, it's well advanced. One with Tim and Brian might take a bit of time to edit.
No, it would be edited. We just did it. I just would have preferred to have some media training. So, yeah, if there's no questions, any other questions?
Were there any questions for Mike? I'm quite conscious we skipped from the legal section onto Tim quite quickly. But does anyone have any purely legal questions for Mike? Any questions in Auckland, Mike, for Tim or Gavin down here?
Question? No, not questions. I just had one observation, and I'm interested in Tim's perspective, just really quickly. You mentioned sort of, and everyone's kind of doing it by degrees, adding more policies and making sure that you've got a policy for this, that, and the other thing. But I wouldn't call it a trend, but a meaningful, a couple of client schemes found with the highly unusual investment fluctuations during the year that an earnings rate policy, and you alluded to earnings rates being obviously a bit more of an art than a science compared to daily unit pricing, that was not objectively wrong and had always been fit for purpose. It was a good time this year to look at refinement so that it is just better responsive as it practicably can be to switching timing and exit timing and being as precise as possible. I just commend doing that proactively, I guess, for those schemes that haven't already put in place, proxy earnings rate policy for the last broken period and so forth.
Yeah, I just support that, Mike. Obviously, the first issue is making sure you're aware and watching for selection against the fund or against the other members through timing of exits or whatever. But I think that was an issue well canvassed in previous downturns, so I'd be surprised if that's an issue for most, but you should continue to check that.
Yeah.
First of all, just in terms of protecting the interest of members, but then also the other side of that is making sure you're paying out fairly. And so if you can find ways to shorten the declaration periods through estimations, so you move from monthly to weekly or weekly, you can try and shrink that time in. The more you can shrink the time in, the better. But it's a trade-off between size and cost and time, and each scheme just has to think about itself and that. And useful time to do it.
It's made even more difficult in the volatility at the moment as well.
Yeah.
What's an accurate rate to apply to someone who's left in between declared rate times? Today's rate might be 5%, tomorrow's might be -5%. So it's a bit tricky in that respect. But it's about being fair, I agree, Tim.
Yeah, without daily unit pricing, and obviously using next day pricing, it's got to be. There has to be some give or take in the overall scheme of things. When markets are going up, the scheme generally benefits. When markets go down, sometimes you can move it the other way, as long as it's not excessive and it's not material for the overall scheme position. Then you'll be comfortable. You got to be able to say that, so members as a whole aren't being materially disadvantaged by the process you're using. Just got to check that from time to time to make sure you're comfortable that that's actually what's happening.
Great. Well, just conscious that of time, and down here in Wellington, our hot food is getting cold, which is a disaster.
And the wine's getting warm.
And the wine's getting warm, even more of a disaster. Things are terrible down here. So I just want to conclude really quickly by firstly saying thank you to our three speakers, given it's always really interesting to see those statistics and just get that feeling about what the restricted scheme industry looks like. We're all busy doing our own thing, and so to get that overview and that snapshot of the size and the fact that we're still all meaningful, we're still of a size and a number, and what's going on. Really thank you for coming and sharing that. It's really useful. Just having a regulator that's prepared to come and sit around and talk to us, it's really helpful. So thank you. Mike, as always, great to have the legislative updates. I saw a lot of people down here nodding their heads, which indicates to me that we've got a group of people on top of all the legislative requirements, but always a great summary and lots of good ideas there from you. Thank you. And Tim, a year in review and what it's like to be at coalface, and some practical tips there. We really appreciate that. I'm sure the group found that useful. So thank you to you three in particular, Alistair and Paul, for your work on the committee. We all appreciate that. And for those of you that came and turned up and brave talking and people in person, really appreciate it. It's great to see everyone. And we hope you enjoy your get together up there in Auckland. Lovely to see you. You're about the size of a postage stamp on our screen.
You've been spared.
Cool. Thank you.
Thank you. Thanks, everybody.
Thank you.
Good.